Let me now bring on board Funny Shekhar. He's fund manager PMS with Angel Stockbroking. Funny, good morning. Thank you for joining us. Funny, Indian markets are clearly digesting last week's monster rally. Things are looking slightly toppy and some stocks are looking slightly rusty. Do you think the big move in Jan is now behind us?
Good morning, Nikunj. While it's certainly good that we are consolidating and trying to digest the rally that we saw in the last calendar year, but I believe that with a possible diesel price hike around the corner and speculation about new reform measures, or more importantly, the insurance and the pension bill being reintroduced during the budget session, will keep the market in good spirits. And I believe that before we talk about any meaningful correction, a meaningful short at 6,300 is very much possible. So, pre-budget rallies are something that we have experienced in the Indian markets. So it seems to be a good time around the first or second week of February for us to maybe test those levels. Having said that, as we approach budget, there is bound to be considerable nervousness, especially in the wake of the government being unable to meet its fiscal deficit target, and more importantly, what happens next year. Because there is bound to be a good amount of populism in the next budget. So I guess first we take a shot at around 6,300 levels, and then we all get nervous as to what happens in the budget, and that might pave the way for some kind of a correction.
What about earnings, Funny, which we're going to deal with before the budget? Are expectations riding high for this earnings season?
Not really, because nobody is calling for a turnaround in corporate performance. This entire enthusiasm is more or less built on a combination of fiscal consolidation along with monetary easing, whose effects at best will only be seen starting second quarter of next financial year. That will be somewhere around July or August. That's at the earliest. So the earnings that we see now will again be more or less what we saw in the last two quarters, around 10% earnings growth with some kind of pressure on margins. But what will be more important is what is the commentary of the corporates, because this is the first full quarter following the reform burst of September. Although it's too early, but do we at least see some signs of corporate India talking up its investors? That will be very interesting to see. But however, what will matter is action on the ground, and to that extent, we are not so bullish on the capex cycle recovering. Although many of the analysts on the street have started penciling in upgrades on that sector. So I guess talking up is the first thing that we will all watch for. But the more important test will come in the fourth quarter and the first quarter, where we have actually will wait to see if there are any new investments happening on the ground.
There is a buzz, there is a thought that we could be in for some strong oil sector reforms, and there is a proposal that diesel price should be increased in a staggered manner. That's a proposal. But do you think this will not see light of the day? Because in the end of the year, or towards the end of the year, we've got 5 state elections, and it will be impossible for government to implement a fuel price hike when you've got 5 big states which are due for elections.
Increasing oil prices in a staggered fashion is an idea that is long overdue, very sensible idea, but it's just too late in the day. I was actually surprised to hear this announcement from the government, because if you really want to do something as sticky as this, then why do you go about and announce it? Whom are you trying to give the message to? To the rating agencies? I guess they are smarter people. To the Indian public, or the political, or to the entire spectrum of political parties, that please gear up for opposing us because we are going to increase the prices in a staggered manner. I don't really get the symbolism of the message. Having said that, you're right that this is something that is much easier to talk than do. What might happen is something that we saw over the course of last 1 year, that is a knee-jerk price increase of maybe 2 or 3 rupees in diesel, and that's it. And maybe just before the elections, which are in the second half of the year, around June or July, you might actually see some kind of a reduction. Even if the currency or the Brent is even a little bit helpful, you might actually see a rollback in the diesel prices also. So the second half of the year is something that should make investors a little bit nervous.
What are your thoughts on Infosys? This time around expectations are low. Do you think Infosys could be more like a sell on rumors and buy on news event?
Well, I guess most of the tactical investors might be out of Infosys by this time, because the kind of investors that you have would like to profit from quarterly results have been disappointed quite often in the last 4 quarters. So what you have now is a small chunk of very long-term investors. For them, I guess the expectations are not very high, because the turnaround that you want to see in this entire strategy of Infosys 3.0 is not yet there. What we would be interested to look for is what is the outlook of the management on the new strategy to win deals. So we all know that the economy, the global macro is quite mixed and challenging for gaining new deals, but the market share within the existing deals which are coming up for renegotiation will call for a high amount of dexterity in pricing strategy, something which peers TCS and HCL Tech have displayed. So that is something that one would like to see from Infosys. Apart from that, volume growth had been tepid for quite some time. That's a function of increasing utilization rates and accelerating projects. That is something that was an area of concern that we would like to see. So all in all, in the very medium term, it's more of how the company has been managing this difficult transition, and it's only over the longer term, by which I mean at least another 6 quarters, for us to know whether this newfound strategy of Infosys has been successful. So to that extent, I don't see much volatility in the stock from results.
From Q3 earnings this time, do you expect more upgrades? Do you expect to hear more upgrades, or do you expect to hear more downgrades?
Well, the room for downgrades is certainly not there. Having said that, absence of downgrades would automatically not mean upgrades. So you would expect a lot of investors to be neutral on Infosys, because, as I mentioned, the transition is not yet complete. One would like to see what are the milestones that the company has crossed towards achieving a more durable volume run rate of 10 to 12%. So till you get there, there is no question of the company reporting you sustainable growth. It will be up and down, as you have seen in the last 4 to 6 quarters. So while the worst is more or less priced in the stock, the room for downgrades from here on, because if you look at the last 4 to 6 quarters, there has been repeated missing of guidance. The growth rates are almost at its 5-year lows. So there isn't much worse that can go from here. So downgrades might not be there, but it is too early for upgrades as well.
Funny, would you agree with my assessment that in terms of risk-reward ratio, in terms of risk-reward equation, in the near term, the scales are tilted towards going long in PSU banks?
Partly, because you're right that as and when interest rate cycle reverses, the upsides for PSU banks are huge, because they have a traditional problem of asset quality, and their valuations are also always on the lower side, giving them the room to expand. But the difference this time around is that inflation is still sticky. So it's nobody's case that inflation will be 7% in March, and from there on it will go up to 5%, 4% and 3%, so that your interest rates can also come down. What the street has been sticking to is some kind of a guidance by the Reserve Bank governor that come January will start cutting rates. Does it mean that he cuts 50 basis points in January and he is bound to cut every credit policy? What might happen is, you might be in the middle of, you might be neither here nor there, which means that the rates might actually be cut, but it might, the reduction in rates might not really qualify to be beginning of an interest rate cuts in a more durable fashion. So what you might see for the entire year is 50 to 75 basis points, and then everyone suddenly starting looking at inflation, because inflation to our mind might continue to remain sticky at around 7%. As far as PSU banks are concerned, yes, while the immediate reduction in rates of 50 to 75 basis points will give them some comfort on the margin, but we must not lose sight of the fact that over the last 4 to 6 quarters, they have gone in for humongous restructurings.
Funny, just want your views on Unitech, and does it seem like interest is now shifting back to some of these real estate names?
I guess it's a combination of a high beta doing well in the market and more importantly a space that is completely underowned. So Unitech at the moment is busy delivering on the projects that were launched before 2009. So a lot of its energies both in terms of management bandwidth and funds are tied up there. Indications are that over the next 6 months or so, they will renew their sales efforts and start relaunching newer projects. One will have to see what kind of response they enjoy in the market. For the time being, with the telecom dispute behind them and the pre-2009 projects being more or less delivered, I guess the company has stabilized as compared to what it was maybe a year back. So with the NAV to market price discount of close to around 20-25% and with opportunities at least in the very near term drying up for investors, I'm not surprised that people are flocking to Unitech, but I'm not sure if it's a great idea for long-term investors.
Funny, Bajaj is a great company, a good quality franchise, zero debt company. They've gained market share in the domestic market and export market is going for them. But at the current juncture, is all the good news in the price?
Yes, it is. So if you remember, we were quite bullish on Bajaj Auto over the last 6 months or so. But with the recent run-up in the stock, mainly based on 3 things. One is the new models like Pulsar and Discover doing well in the markets, regaining incremental market share, exports picking up, and more importantly, new 3-wheeler permits by states such as Delhi have actually helped Bajaj Auto stage this spectacular rally of almost 400 rupees in the last 3 months. At this juncture, at around 17 times FY14 earnings, even if you consider a 22% earnings growth, which by itself is no mean task, although that can very well realistically happen, there isn't any near-term upside both in terms of valuation as well as earnings growth. So for the moment, I guess from here on, it will be a bit risky to invest in Bajaj Auto from a very near-term perspective. So a good idea will be to wait for the stock to decline to levels of around 1900 and then take a longer-term call.
Funny, what about Maruti? While 2012 may have seen a new all-time low when it comes to the market share, but do you think all the bad news is now in the price and it's a good valuation to get into the stock, as is the belief with the, some of the brokerages like CLSA?
Not really. I think most of those calls are clearly, and more importantly, price targets are clearly predicated on what the outlook for yen is. Because this rally of Maruti is predicated merely on the depreciation of yen. So while the other drivers are very much in place, that the company has actually started producing more cars at Manesar than what it was doing before the strike. You also have the incremental market share of around 40-42%, with interest rates going down by 50 to 75 basis points over the next 12 months. The first beneficiary of that will be the retail loans, especially the auto loans. So while all these drivers are intact, it will be a bit rich for us to assume that FY14 the company can deliver in excess of 25% earnings growth, because that is what is factored in the prices. Because growing the overall size of the market and retaining its market share by itself is a big challenge for Maruti. And as we have seen the December sales, the market is hugely mixed, with the competitors like Hyundai and Tata Motors badly suffering while Maruti did reasonably well. So I guess it's not a good idea to get into Maruti at these levels. Maybe if the stock corrects to levels like 1250, 1300, it might be a good investment.
Last question, in last 1 month, identify some names which you have added in your portfolio. Similarly, tick mark some names for us where you've reduced your exposure.
So stocks such as Bajaj Auto is where we have reduced our exposure. While housing NBFCs like GIC have been added to our portfolio, because we see that among that entire pie of NBFCs, housing is the strongest one. While on the defensive side, a mid-cap pharma name called FTC has been added by us, because we see that irrespective of what happens on the inorganic front with that company, even on organic growth fundamentals, the valuations look extremely appealing. So from a longer term perspective, we like that stock.